Hey, I'm Alex.
And I'm Alex,
Okay, right off the bat, we have to admit something.
that we're not actually human.
Yeah, sorry about that. So, we want to start at the very beginning, the absolute basics of investing. If you have no idea about the world of finance, this is where to start.
Yeah, even for seasoned pros, there's so much here to unpack.
All right, let's dive into the world of investing with the Financial Times Guide to Investing. We're going deep, giving you the basics so you can navigate the markets like a pro.
You know, it's interesting. People often think investing is just about making money, but there's so much more to it. It's really about understanding businesses, how they work, how they grow, and how it all fits into the financial system.
Absolutely. It's like getting a backstage pass to the world of business. But before we get too far ahead of ourselves, let's start with the fundamentals. What exactly is investing? The book says it's about putting your money to work, hoping it generates income or increases in value. Makes sense, but is that all there is to it?
Well, that's the basic idea, yeah. But it's really crucial to go a bit deeper. Imagine throwing darts at a stock board, just randomly picking. That's not investing, that's gambling. What separates a smart investor from someone just taking a wild gamble? It's about making informed decisions, doing the research, and understanding what you're getting into.
Okay, so it's not just about luck, it's about strategy. But then there's this whole idea of ordinary shares and extraordinary returns that the book mentions. That definitely makes it sound a bit more exciting than just research.
You got it. That's where things get really interesting. Let's imagine a company, a tech startup, for example, needs money to grow. What they can do is issue shares, which are basically tiny pieces of ownership in that company. So when you buy those shares, you're essentially betting on that company's future success.
So that startup takes off. If it becomes the next big thing, my little piece could be worth a fortune.
Exactly. That's where the potential for extraordinary returns comes in. And here's the thing. If things don't go as planned, your risk is limited to what you put into those shares you bought. It's a safety net for calculated risk.
I like the sound of that. But how do I actually see a return on my investment? I mean, it's not like holding onto a stock certificate magically makes money appear.
Right. You're right. It's not magic, huh? There are a couple of ways you can profit. The first is through dividends. Think of it this way. If the company is making a profit, they can choose to share some of those earnings with their shareholders.
So it's like getting a little bonus just for owning a piece of the company.
Exactly. And the other way is through what are called retained earnings. That's when the company takes its profits and reinvests them back into the business itself. That can make the value of your shares go up, even if you're not seeing cash returns immediately.
Got it. So it's kind of a long-term game, but with the potential for big rewards down the road. But what about when I'm ready to actually cash in on those gains? How do I sell my shares?
That's where stock markets come in. They act as platforms where buyers and sellers can get together and trade shares. It's kind of like a giant auction house, but instead of art, it's pieces of companies.
Ah, so that's where the action happens. But the stock market can be a bit intimidating, right? Where do you even begin?
It can seem complicated, yeah. First, you'll need a stockbroker. Think of them as your guide to the market. But the good news is, these days, there are tons of online platforms that make it way easier. You can research companies, check stock prices, even make trades all right from your computer or phone.
So technology has opened the door for everyday people to participate in the market. That's great. But you always hear about people losing big in the stock market, those horror stories. How do you manage that risk?
You're right. Investing, there's always some risk involved. That's why diversification is so important. It's that old saying, don't put all your eggs in one basket. Instead, you spread your investments, different companies, industries, maybe even other types of assets like bonds or real estate.
So it's like building a safety net, just in case one of your investments takes a hit.
Exactly. You want a portfolio that can handle those ups and downs, the market fluctuations, and without putting your entire financial well-being at risk.
Makes a lot of sense. But even with diversification, it feels like you'd need to be really knowledgeable to pick the right stocks. How do you know which companies are actually worth investing in?
That's where analyzing company accounts comes into play. It's like you're looking under the hood, trying to see what's going on. You examine the financial statements, things like the profit and loss account, the balance sheet, the cash flow statement. These give you a much clearer picture of the company's financial health, whether it has potential for growth.
Okay, but those statements, they can look pretty confusing if you don't have a background in accounting. Can you make sense of them without needing a finance degree?
You bet. We can break them down into smaller pieces, focus on the important parts. Imagine this. The profit and loss statement, that tells you how much money the company made and how much it spent over a certain period. It's like their financial report card. Are they profitable?
So it's like seeing if their business model is actually working.
Precisely. And then you have the balance sheet. This is like a snapshot. It shows you their assets and liabilities at a specific moment. Think of it as a financial health checkup. It tells you what they own, what they owe, and ultimately what they're worth overall.
So we've got the basics down, stocks, company financials, all that good stuff. But this book keeps mentioning other investment options beyond just individual stocks. It's almost like there's like a secret menu we haven't even seen yet.
That's a good way to put it. There's definitely a whole world out there to explore. And remember, diversification is key. That means thinking beyond just one company or one type of asset.
Okay, so what else is on this secret menu of investments? The book keeps talking about pooled investments, but honestly, I'm not really sure what that even means.
All right, imagine this. You want to invest in real estate, but you can't exactly buy an entire apartment building on your own, right? Well, a pooled investment, like a real estate investment trust or a REIT, lets you pool your money with other investors. So you collectively own a piece of that building.
So it's like kind of like crowdfunding, but for investments. That's pretty cool. So are there other types of pooled investments besides these REIT things?
Oh, absolutely. A really popular one is a mutual fund. It's basically like a basket of stocks, bonds, or other assets, all managed by a pro, a fund manager. When you invest in the fund, you're actually buying units, and each unit represents a little piece of all those assets.
So it's like diversifying within your diversification. You're not just getting one stock, you're getting a whole bunch of them in one package.
You got it. And that diversification helps to lower your risk. Plus, you've got that expert fund manager making the investment decisions.
That sounds perfect for someone who doesn't have the time or the knowledge to pick individual stocks. But what if I still want some control, even with the diversification?
Then there's exchange-traded funds, ETFs, kind of similar to mutual funds. They track a bunch of assets, but they're traded on stock exchanges, just like me.
So you get that fund diversification, but you can buy and sell them whenever the market's open.
Exactly. ETFs are a great option if you want a diversified portfolio that you can manage, and they're usually pretty low cost.
This is making me realize stocks are just the beginning. The book also talks about bonds, which I always found kind of confusing. What are those all about?
Think of bonds as loans. You're lending money to a government or a corporation. You buy a bond, you lend the money for a certain time at a fixed interest rate.
Oh, okay. So it's a way to get a steady stream of income. Is it as risky as stocks?
Generally, bonds are considered less risky than stocks, but they also don't have the same potential for high returns. They're a good option if you're looking for stability, steady income, especially as you get closer to retirement.
Okay, that makes sense. But what about those big investors? You know, the ones making huge bets on risky stuff. The book mentions hedge funds. Are those only for super rich people?
Hedge funds, yeah, those are definitely more complex, more sophisticated. They use all sorts of strategies, leverage, derivatives, trying to get those high returns, but they also come with higher risk. And usually you need to be an accredited investor with lots of capital to even get in.
So that's like the big leagues of investing. Not for beginners, right?
Boy, yeah, got it. Hedge funds are a whole different game. You need a really good understanding of the markets and how to manage risk.
Good to know. But for those of us not quite ready for hedge funds, there are still plenty of options for diversifying, right? The book mentions some unusual ones, like business angels and crowdfunding. Those sound kind of interesting.
Those are great examples of how things are always changing in the investment world. Business angels are usually wealthy individuals who invest their own money in startups, early-stage companies.
So they're like mentors with money. Seems risky, but could be rewarding too.
It can be. They often provide more than just money. They offer guidance, expertise, help the companies grow.
And crowdfunding. I've seen websites where people could donate small amounts to like creative projects or inventions. Yeah. Is that considered investing too?
It is. Crowdfunding lets you invest directly in projects you like, businesses you believe in, often for a pretty small amount of money. It's a good way to support new ideas, get involved in startups early on.
The more we talk, the more I realize there's so much more to investing than just buying stocks. But with all these options, it seems like due diligence is even more important, right? Really understanding what you're putting your money into.
Absolutely. No matter what you're investing in, you got to do your research, know the risks, make decisions that match your financial goals.
We talked about analyzing company accounts for stocks, but how do you evaluate other investments, like bonds or real estate? Different tools, different strategies.
You're right. Each type of investment has its own things to look at. For bonds, you'd want to check things like the interest rate when it matures, the credit worthiness of whoever issued it.
So it's all about knowing how likely you are to get your money back, plus the interest payments.
Exactly. And for real estate, you've got to consider location, condition of the property, how much rent it could bring in, what's happening in the real estate market in that area.
It sounds like you need a whole different set of skills for each type of investment. Is it even possible for one person to be knowledgeable about all that?
That's a good point. It's definitely tough to be an expert in everything, but that's why diversifying and getting professional advice can be so helpful.
Speaking of professional advice, I'm curious about financial advisors. The book mentions them, but are they only for, super wealthy investors? Or can they be helpful for someone just starting out?
Financial advisors can be great for anyone, no matter where they are in their investing journey. They can help you create a plan, choose the right investments, even manage your portfolio for you.
So it's like having a personal trainer, but for your finances. They keep you on track, help you make good choices.
Exactly. A good financial advisor is like a trusted guide. They provide expertise, they're objective, they can give you peace of mind.
This has been really eye-opening. It's like I'm learning a whole new language. I actually feel excited to start investing now.
That's the spirit. The world of investing is always changing. There's always something new to learn.
Speaking of learning more, I'm curious about different investment strategies. The book talks about value investing and growth investing, but I'm not sure I understand the difference.
Those are great examples of different approaches, and we'll definitely dive into those in the next part of our deep dive.
Perfect. I'm ready to go even deeper and figure out how to put all this knowledge into action. All right, welcome back for the final part of our deep dive into the Financial Times Guide to Investing.
We've covered a ton of ground, everything from stocks and bonds to even crowdfunding and hedge funds. It's a lot to take in.
It is, but what's really cool is how it all connects. It's not just about, knowing the different options. It's about coming up with a strategy that really works for you, your goals, and how much risk you're okay with, right? We've got all these ingredients now, but we need the recipe to actually bake the cake. The book talks about different investment philosophies like value investing and growth investing. But to be honest, that just sounds like financial jargon to me. Can you explain it in a way that normal people can understand?
Of course. Let's start with value investing. Think of it as treasure hunting, finding those hidden gems. Value investors, they look for companies that they think the market is undervaluing. So these companies, they might have solid fundamentals, but maybe they've had a tough time recently, or maybe the market just doesn't see their true potential yet.
So it's like finding a diamond in the rough, a stock that's priced lower than it should be.
Exactly. Value investors, they believe that over time, the market will catch on and the price of that stock will go up to reflect its real worth.
Okay, so patience is key with value investing. You're in it for the long haul. What about growth investing? Is that more about jumping on the hot new trends?
Growth investors are definitely looking for companies with a lot of potential for growth, the ones expected to grow faster than the overall market. They're often in those innovative industries, maybe disrupting the way things have always been done.
So it's like investing in the next big thing, the company that everyone's going to be talking about a few years down the road.
That's the idea. Growth investing can be riskier because you're betting on future potential, and there's always more uncertainty there. But if you pick the right companies, the payoff can be big.
This is making me think about, my own risk tolerance. How do I know how much risk I'm comfortable with? Is there a way to figure that out before I even start investing?
There are definitely some tools and questionnaires that can help you assess your risk tolerance. It's also really important to think about your time horizon. If you're investing for a long-term goal, like retirement, you might be okay with a little more risk because you've got time to recover if the market dips.
Makes sense. It's like deciding if you want a spicy pizza or if you're going to play it safe with just cheese. But once you've figured out your risk tolerance, your investment style, how do you actually build a portfolio that reflects all that?
That's where asset allocation comes in. It's deciding what percentage of your portfolio goes to different asset classes like stocks, bonds, real estate, maybe even some alternative investments like commodities or precious metals.
So it's like deciding how much of your pizza is pepperoni, how much is veggies, based on your taste and what you feel like eating.
Exactly. Your asset allocation, it should be tailored to your specific needs and goals. For example, a younger investor, maybe they're more comfortable with risk. They might put more of their portfolio into stocks. Someone nearing retirement, they might prefer a more conservative approach with more in bonds.
And how often should you, check in on your asset allocation? Is it a set it and forget it kind of thing, or do you need to adjust it over time?
It's smart to review your portfolio regularly and make tweaks as needed. Things change, right? Life events happen, the market goes up and down, maybe your own feelings about risk change. All those things can mean you need to adjust your asset allocation strategy.
So it's not just about building that perfect portfolio, it's about making sure it still works for you as things change. This all sounds pretty hands-on. Is it really possible for someone with a busy life to manage their own investments, or should they just leave it to the pros?
That's really a personal choice. There's no right answer. Some people really enjoy the process of researching and picking investments and managing everything themselves. Others prefer a more hands-off approach.
So if you're the kind of person who loves digging into financial statements and following all the market trends, maybe DIY investing is for you. But if you'd rather spend your time doing other things, a financial advisor can be a big help.
Exactly. Financial advisors, they can give you personalized advice, manage your investments, even offer insights on things like retirement planning, taxes, and estate planning.
Wow, it sounds like they can really take a lot off your plate and help you make smart financial decisions. But how do you even find a good financial advisor? Is there like a secret society or something?
No secret society, but it's really important to do your homework and pick an advisor who you trust and who understands what you want to achieve. Look for someone who is certified, has experience, and most importantly, acts as a fiduciary. That means they have a legal obligation to put your interests first.
Okay, so qualifications are important, but so is knowing they're on your side, looking out for you. Makes sense. This whole deep dive has been amazing. I honestly started feeling intimidated by investing, but now I actually feel empowered to take control of my finances.
That's great to hear. And remember, investing is a journey. It's about constantly learning, adapting, and making decisions that match your goals and values.
Well said. Thanks for joining us on this deep dive into the Financial Times Guide to Investing. We hope you've learned a lot and, most importantly, that you feel confident to start investing and building a brighter